Welcome to East Coast, West Coast. I am Danny Rocco, and with me is my amazing, what would I do without this brilliant man, my co-host, Mike Flynn. How are you doing over there in Seattle today, Mike?
Thank you for letting me be in your program.
What would I do without you? It would just be me. That's enough of that. I need you to make this thing cool.
Oh, I see. That's cool. Well, it is fun to bring some interesting West Coast people who have a national reasons to be interesting nationally, and certainly David Jacobs is one of those. So back to you.
He is. And David Jacobs, tell us a little bit about, I know who you are, Mike knows who you are, but tell the listeners a little bit, a snapshot of who you are, David.
Danny and Mike, thanks so much for having me on this afternoon. I really appreciate it. And I'm glad you guys are staying safe and healthy. I grew up actually in the St. Louis area. My dad was in medical school at the time at Washington University. And then soon after, he did his residency out in California, and my family moved out to California. I started in Southern California, but grew up most of my life, junior high school and high school in Northern California, just north of San Francisco in Marin County, small town called Mill Valley. And gradually, I worked my way down the coast. I ended up going to college in Santa Barbara, law school down here in San Diego. And then I realized I couldn't go any further south. And I met my wife and 2 kids and a dog later. We're still here in beautiful northern San Diego.
Well, there you are. Now, today we're going to talk about the amazing, exciting, fun world of life insurance. I'm with you with that. We can be fun and exciting in the life insurance world, right, David? But
we will.
Yes, we're going to bring it home, add some comic relief to it. No, but seriously, there are other things that you do just besides the life insurance part. So before we get into that, can you talk a little bit about all the other things that you're part of?
Well, yes. In addition to having two great partners and a firm that is, our firm really is specifically focused on life insurance planning. But as members of our community, we like to spend a lot of time interacting with other professionals and community members. So I currently sit as the treasurer of the North County Estate Planning Council of San Diego. I'm recently served as the Southern California membership chair for the Family Business Association of California. And I was, prior to that, chairman of the board of directors of Center for Community Solutions, which is a nonprofit here in San Diego that focuses on reducing domestic violence and sexual assault.
Well, that's very cool.
Wonderful organization.
So, give us a sense, if you could, of how has the coronavirus environment impacted the life insurance industry?
Well, it's a great question. And as you can imagine, the life insurance industry is somewhat impacted by COVID-19, but maybe not in the ways that one would expect. I think the first thing that we're seeing is a lot of people are making sure that they still have life insurance coverage. They're very, events like this do have a tendency to make people think about what would happen if they weren't there anymore. And so we are getting a record number of calls for just policy reviews to make sure that the policies are in good standing and that the carriers are still of top quality in this environment. But the carriers are also adding, you can imagine, questions to their medical forms and authorizations. There are some new testing protocols related to COVID-19. For instance, most carriers will delay offering you coverage if you have had COVID-19 until you've been COVID-19 free for at least 90 days and have 2 negative tests.
Really?
So, another interesting.
That makes sense, though.
It does. Another interesting thing to kind of look at is to realize that because unfortunately most of the victims of COVID-19 are over 70, there are some hesitations by several carriers to issue large life insurance policies for individuals over 70. And they are postponing some of those larger decisions until after July 1st, until maybe there's a little bit more clarity on some of the effects and impacts of COVID.
Oh, so
Yeah, let me add one more point in there. I think one question that people would probably intuitively ask is, well, if there's increased mortality, wouldn't that have an impact on the life insurance carriers, since more people are dying than normally would without the COVID? And the answer to that is that most of the deaths have been, again, with older and less healthy people. And those are people who already are not expected to live very much longer. And so the insurance companies aren't expecting many more years of premium from them. Or maybe they were not insurable anyway because they've already had pre-existing health conditions and weren't even able to get insurance. So it really is just a blip on the radar, the mortality so far for the life insurance carriers. There are a couple of things that they can do if things get a lot worse. But so far, no companies have, for instance, raised their cost of insurance charges or done anything to negatively impact the consumer because of COVID, other than a little more difficult in the application and approval process.
So what else could be an adverse effect? It sounded like there was something you weren't mentioning.
Well, I do think that life insurance carriers are uniquely positioned to weather something like a COVID-19. They have very high reserve requirements, especially compared to banks, and they have a profit center, which is term life insurance, that is not correlated to ups and downs of the economy, Democrat or Republican in office, interest rates up, down, market good, bad. Mortality is generally measurable and a large profit source for life insurance companies who offer term insurance. Just to get a little bit more detailed, term insurance is really for it's really for a period of time. Let's see if I can get that. Let's go ahead. Go ahead, Mike.
My lifetime.
Well, yeah, and there's because term insurance, because most people don't pass away owning term insurance. Most people outlive the life of their term insurance. And because of that, the life insurance carriers very rarely have to pay out on term life insurance claims. Right. So it's a large profit center for the carriers that really isn't impacted by politics, markets, anything like that. Completely non-correlated asset for them.
Yeah. So one of your products, Mike, I'm glad you asked that about the current situation, because it's on the forefront of everybody's mind, right? How is this going to affect me with my insurance? How is this going to affect the housing, our car dealerships, every piece of it? But you have a unique product that we kind of briefly talked about. It was like Liquidity Plus is the name of it. And I haven't really heard that much about that. What makes that product so specific and maybe even better, or in this day and age, right? In this market, that might be something. So I'm going to get off a little bit of that topic and transfer here into that. Can you go into that?
Yeah, that's a great question, because the other thing that we've certainly seen since the COVID-19 crisis, and honestly, the 10 years prior, is extremely low interest rates. And interest rates dropped again just a couple of weeks ago. And so when interest rates are this low for this long period of time, there are very few options for people to place their safest and most liquid capital and still get some kind of a meaningful yield. Just to remember the rates of just a couple days ago when I looked at the paper, I mean, we had 1-year CDs below 50 basis points. We have muni bonds in the low 1%. These are places where organizations and individuals are used to placing their safest and most liquid capital. And for the last 10 years, and especially the last year, there have been very few opportunities to achieve any yield on those types of assets unless you want to sacrifice creditworthiness or take on extra risk, which is not for the piece of the pie that we are talking about. This is for the safest assets that are there. And so what we did is, in this rate environment, we went back and we looked at some policies that were typically issued to banks. And banks, for the last 38 years, have been buying institutionally priced life insurance contracts. In fact, banks are the largest purchasers of life insurance policies of any industry. And currently, it's just about $300 billion worth of cash value is on the balance sheets of US banks. To give you an example, Bank of America currently owns about $23 billion of cash value in life insurance policies. They own about $19 billion in real estate. So that should give you it's a significant asset on commercial banks' balance sheets. And the main feature is they are cash value driven rather than death benefit driven, and they are institutionally priced. So the banks are buying these policies not only because they want to insure key people in case they may pass away, like a key executive or a president, but what if they can get a higher yield on the cash value than they can get in the other safe assets that they're also investing in? And that has been the case for the last 38 years. And in fact, bank regulations say that up to 25% of a commercial bank's tier one capital, which is their safest and most liquid capital, can be invested in these high grade institutional life insurance products. And so we looked at these products and realized that over time, these yielded about 3 to 6%. And we said, boy, in other interest rate environments, 3 to 6% doesn't look so great. But in today's interest rate environment, and for the last 10 years, 3 to 6% looks terrific.
Yeah, right.
And in addition to getting that kind of a yield, you are placing your money with insurance companies that have been around, many for over 100 years. The banks are certainly comfortable with that risk profile. And you're utilizing the types of contracts that have been used, by banks for close to 40 years. None of those contracts are exposed to the market. They all have floors. And so we just want to make sure that there's no opportunity to lose money. We want to make sure that there's only an opportunity to gain money. And so these contracts really only perform sideways and up. They don't go down.
Well, that is, people are gotta love that. I know Todd's geeking out over here and commenting, so we'll have to go back in there because he's loving everything you're saying, David. But can you, before Mike goes into that next question, who are these good for? Like, I'm sure it's not just the average Joe. There must be a niche or a concept of a person.
Yeah, there is. I think because this is really for the conservative portion of either an organization's or an individual's portfolio. So a good example of a great fit is a nonprofit that holds significant safe assets on its balance sheet. Maybe it's in cash, CDs, treasury bills, short-term bonds. Let's just take an example that organization has $8 million worth of assets in that asset class. We would take a look at about 25 to 50% of those assets and look at the rate of return they're earning now. And if it's something less than 3 to 6%, which we know it is, if it's invested in the bank or cash or savings, then we should be able to improve the bottom line of that organization's balance sheet. The same thing applies to individuals and businesses. They're a little bit different because of the tax differences between a nonprofit and a for-profit business or family. But the same concept can be used, and those differences can be worked out in the details. Yeah. So as I'd say that the minimum amount that really works is $250,000. And the largest that we've seen that we've done in the office has been over 100 million, combining several different insurance carriers together, of course, to reach that amount.
If you look ahead, how long would you anticipate that opportunity is likely to be there?
Well, fortunately, the mechanisms that drive the growth of the cash value in these policies are positively correlated to interest rates. So as interest rates go up, which they should eventually, because we can't go down a whole lot further.
Aren't we in a V shape?
Yeah, I mean,
with blank on
where
that.
are we? We're way down there, and we're in negative territory. And as we start to come up, these policies should perform better as interest rates rise.
Okay. That's good. I want to make a quick thing. Does anybody, David or Mike, do you have a radio or anything on? Someone said they're catching feedback, and it just might be a microphone.
I don't think it's mine.
Just live technical stuff. I had to put it out there. Okay. Todd wants to know, David, before I continue on, is it universal, variable, whole life, or other?
We actually have three different, it's a great question, Todd, thanks. We actually have three different models, but none of them are variable because we don't want to have any market risk or exposure. These really are the safest assets that the organization or the individual is going to have. And so exposing it to any downside risk we don't want to do. In addition, sometimes these assets are pledged as collateral for loans, life insurance policies, including the cash value. And if they're variable policies, they're not very good collateral instruments to lend against. So we want to make sure that they are fixed policies, only placed in the general account of life insurance carriers, not in separate accounts that variable policies involve. So we have a whole life model, a universal life model, and an index universal life model for anybody who is as experienced as Todd on this call.
So what are the tax implications for all of that?
Tax implications are very interesting, and it does depend a little bit on whether or not you're a for-profit and a nonprofit organization. Let me start with the fact that nonprofit organizations are easy to approach on this because of their tax situation, right? They don't pay any tax at any level. The employees do pay some tax, but we're really talking about the corporate and organizational level does not pay tax. So they're able to fund these policies typically on a single premium basis. For instance, there's $2 million of cash at the bank. They move all $2 million over at one time into a life insurance contract. That $2 million will grow at between 3% and 6%. And there will also be a death benefit. It is a life insurance policy, and there will be a death benefit of about 2 to 3 times that deposit. So a $2 million deposit might buy, 4.5, 5, something like that, $1 million worth of insurance. But this is really not in case somebody dies. This is really, we want somebody to live, and we want to increase the yield on these safe assets while they're alive.
Talk to me about if you want to put money in, you want to take money out. Do you have to watch the market? I know you kind of answered that, but do you have to watch the market? You're going to take it out, pull it in. How does that affect it?
It does depend. There are certain types of contracts and certain carriers that do allow you to put more money in over the years without going through additional underwriting. So remember, the life insurance does take underwriting. It isn't the most pleasant thing. And so if we can avoid underwriting, we'd like to. And some companies and some contracts do allow you to put in additional funds later on without additional underwriting obligations. So that's great. If that's something, what's a conversation we have at the beginning, if it looks like it might be something you might want to add to later, we want to take that into account.
All right. Todd wants to know,
so
David, you said Nelson Ash's material.
I have not.
Well, you might want to put that on your reading.
Well, I guess I better put it on my reading list.
Okay, my turn, and I'll ask a question so he recovers. So you're familiar, obviously, with family businesses. How is what's happening now with this virus impact likely to change situations for family business and transition planning?
I mean, the COVID, the impact of COVID-19 is not having that much of an impact in that realm. I would say what's having more of an impact is the low interest rates and the low applicable federal rates, which are used for estate planning and for loans between family members, typically when doing estate and wealth transfer planning. And those are now at historic lows. And so if there's a desire to transfer wealth from one generation to another that involves making loans from one family member or entity to another, those are at historic lows now, but those aren't really due to coronavirus necessarily.
So if it's at historic lows, it's a historic opportunity then, basically.
That's correct. And there's historic opportunities, but I think there's also some hesitation. A lot of people are taking a wait and see approach right now, not only with COVID and health related items, but with estate taxes. And wealthy individuals, wealthy families are often concerned with estate taxes. And depending on what happens with the elections in November, there may be a big change to that estate tax regime. And I think a lot of people might be making some decisions to wait it out if they can afford to do that.
That's interesting. Okay. Mm-hmm. Danny?
Do you think that, I know that this COVID-19 corona is going to open any new products, or do you think it's just a little bit more questions and waiting process under the underwriting?
I don't think they're the only new products I've seen come out. That's actually pretty counterintuitive, but I've actually seen 40-year term insurance policies come out. I haven't really seen those before. 30 is typically the longest. Yeah. I don't think this is gonna create any new product, but I do think it is going to allow people to take a second look at life insurance as a conservative vehicle with which to hold wealth and transfer wealth, and it does have unique tax advantages. I know, Mike, you asked that question earlier, and that's probably a whole topic for an entire webcast itself. But the tax advantages of life insurance can be significant, and that's why it's typically used for wealth transfer.
I have a question here too from one of the live streamers here. Do you have what is your personal professional prediction on estate tax?
Am I allowed to not make predictions? Because you can take this one to the bank that it will be wrong, because everybody is predicting. Everyone's kind of predicting the same thing, which means, of course, it's not going to happen. The professionals that I have been speaking to have been looking at somewhere between $7 million and $10 million per couple. That's what I've been hearing. I don't know if that's going to be a good guess or not. Last time everybody was way off.
So, but that's the news out there. Thank you.
I'd love to hear everybody else's predictions.
Well, when they pop up on the comments, I will let you know. We're coming to a close, and I want to give you this opportunity to any advice or anything that you would like to share, or maybe not predictions, but more recommendations, to the people out there.
Can I ask you?
Oh, Mike.
Can I ask a question before he answers that?
Yeah.
You're involved with the estate planning. What are the issues in estate planning that people are talking about now? Touched on life insurance, but what beyond that?
Well, I think estate planning, certainly taxes have and continue to be a concern. I do think that there is a greater concern and recognition for asset protection. And I do think that we have seen a lot of our clients recognize that things can happen to their assets after they're gone. And that can include fights among heirs. And if they can just
Well, does that happen?
Never heard of that before. If they can just be a little bit, more proactive, doing the planning in advance, I think you can avoid a lot of those pitfalls when, you're not there any longer. And I think people are starting to come to that realization a little bit more and take advantage of the mainly legal and financial tools to help that out.
I'll show you one little joke. I tell my kids that the way their estate's going to be handled is my grave will have a little button on it, and you have to visit me each month and push the button to get your share this month.
Actually, Mike,
written in your will.
An inventor and an ingenious idea. You might want to trademark that.
Right.
Back to Danny's question.
Yeah, I mean, I would say one, I just want to, just make sure everybody out there does review your life insurance coverage. You don't have to do it with me, but just make sure you do it to make sure that you're that everything is still in place, that your company is still in business, and that your coverage is what you expect it to be. But in addition to that, I really do think that people are taking a second look at using life insurance as a current asset, not just what happens if I pass away, but how can I benefit from the cash value portion of permanent life insurance while I'm alive? And can that grow faster than other types of assets that I'm investing in, like CDs and treasuries and municipal bonds? And if they do, there's a real opportunity, I think, for people to get higher yields, even in this really low interest rate environment. And quite frankly, these policies tend to be very, very liquid. And so if there's second thoughts down the road, 4 or 5 years go by and it's not of interest anymore, these can typically be cashed out with no surrender penalties.
Well, it sounds like a very nice way to diversify your portfolio.
Especially in this low interest rate environment, it's really unique.
Yeah. Mike, do you have anything else before we say goodbye and let David go be amazing on the rest of his day?
Well, you could invite us down to San Diego the next time we do this.
Well, yeah, I think we can invite ourselves.
There's Del Mar right behind me.
Yeah, that's it. Okay.
That's the racetrack.
We know where you live, David.
Okay.
We'll find out.
Nice to see you.
Thanks again for having me this afternoon. I appreciate it. It was really good to see you.
Oh, thank you for being on, David, and everybody else. We will see you the next time the East Coast and the West Coast collide. Have an amazing rest of your day.